Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, April 10th, 2024. It's 1:18 p.m. or 1:19 right now as I'm starting the video, and this is video number two. I'm going to just go over a bunch of charts. Here's what we're going to do. There are going to be some trade ideas on individual stocks, individual sectors, and then I'm starting here with one. This was a question I saw that I missed the other day from a subscriber, Alan. So I'm going to go over Lululemon for you. He had a question about that. And then I'm going to rifle through two watch lists. Hopefully I can get through them. I'll go through them fairly quickly. I won't spend too much time on any one stock or sector. I have a watch list of various indices and sectors. I want to go through that one, kind of show you what I'm seeing. There is a common theme pretty much going on right now throughout the market. And then I have my TTW watch list, I call it, things to watch. I started that one over a year ago now, shared it with you on those. It's just a compilation of select individual stocks and or sectors that I think are important to watch for both the economy and the stock market. So I'm going to start here with Lululemon. That was the question from subscriber Alan. Said, did you think the selling's over? Does it have any more downside? Probably. Here's the thing. We're at support. This is my weekly chart. I'm going to flip over to my daily in just a second. But there's an uptrend line. That's support right there. There's also some price support I have it at now coming up on. But when I look at this chart, I'm going to roll back here. What I see is a massive divergent high. Big divergence that's been building. The stock inching up. Like the stock market, a lot like that, making new highs. And no, I think based on, now we may have a reaction here, may not. But I do think ultimately the stock's probably going to come back down there, at least at 263 level. And that's going to pretty much, where was it at recently? It was at 523. So yeah, it's going to cut the stock in half if it gets there. Now, let me jump over to the daily chart. So this is interesting. So this is my daily chart. Haven't touched it. These lines you can see here. Let's see, when you pop up the pop-up box, I'll tell you I created that back in March of 2024. Put in a divergent high, then it broke this trend line. And this line here, so it's at horizontal support, as I just mentioned on the weekly. You can see I created that back in July 31st. That support level 349.44, and it just hit it today pretty much. So, and you can also see on the same day back in July again of last year 2023, I created this trend line. That's the trend line I had on the weekly. And so I'm going to edit it now and show you what happens when I extend it right. Boom. So it comes in there. So there you have it. The stock has already fallen. I certainly wouldn't short it. I think it's going to be probably a candidate of a short covering rally soon. However, I'm going to go over my view on the market here, and therefore I would rather, I wouldn't take it. That's just me. I wouldn't short it here either because it's way too stretched, way too oversold, deeply oversold. Last time it was this oversold was right here. And if you tried to short it then and you didn't stop out, you lost, the stock went up 55%. So, but again, I just showed you big picture and there's my thoughts on it. So yeah, it's support. Okay support level, not super duper great support. I'm going to give you the next one in case it goes through there. Down here, there's a big old gap, bottom of a gap there, and another gap right there. So that's support there. Let's not spend too much time on it. There's my thoughts. So, like I said, if certainly wouldn't short it here. If you put a gun down my head, I'd probably buy it for a. You can make a case. You've got some positive divergence here on the 60-minute chart. Short covering rallies are my favorite thing to trade in a bear market because they're so powerful. The stocks tend to go up so fast. Here's a short covering rally, a bear market rally right there. If you jumped on it in just a matter of, what is that, 3 weeks, you made 50% on your money. And then you turn around and drop over that much. And so that's why trading bear markets is just so frigging profitable if you can get in and trade the trends both down and up. Stocks tend to fall a lot faster than they rise, and the bear market rallies are phenomenal. You can make what you'd make in a year or two in a matter of weeks on the right stock, the right setup. And back then you can see I had the divergence line here. It's not showing. I didn't have it marked, so it wasn't a random 50% rally. It was a bear market rally based on the positive divergences and probably other things at the time. Now my brain works tangentially, so Lululemon made me think of you know, made me think of my wife. She years ago, I remember her ranting and raving about Lululemon. They make great products, yoga pants and all this other stuff, and so it's a great brand name. I don't have to tell most of you that, that, especially women. I think they make men's stuff now too, if I'm not mistaken. But it reminded me of Yeti, because there's another stock. I mean, Yeti's been around for years. I'm a boater and fisherman and all that, so I'm very familiar with their products, and they make some good stuff. But I remember my wife also telling me a couple years ago to short Yeti. She loves Home Goods. Home Goods, for those of you that don't know, they're owned by TJ Maxx. It's kind of like that same concept of discounted products. Whatever they get in stock, they buy, I guess, surplus stuff, from wherever they're getting it from, and the prices are great. And she said one day she came home and said, she goes there all the time. We have one couple of them here where we live, and she said they had Yeti just flowing all over the shelves. Yeti this, Yeti that. Now Yeti, if you recall, kind of like Lululemon, certain big brand names they just never discount. They don't need to. They haven't had to. But when you start seeing the discount stores again, that's what Home Goods is. It's owned by TJ Maxx, or just like the clothes that they buy. If Tommy Hilfiger has a surplus at the end of the season of blah blah blah, that's what's coming on the shelves. They're going to get various sizes. So it tells you, bottom line, tells you they have an inventory problem. They're not selling, they're not moving their product. That's why you're going to see it discounted, and that's kind of the kiss of death. And it was, and I was back here somewhere, and the darn, it wasn't random either. Everything's priced in the charts. Not everything, but most of the time it is. There was an uptrend line break, perfect back test. That back test coincided with a big divergent high, negative divergence. And from that back test, the stock fell 74%. You would have been wiped out if you were long and didn't get in there, and you would have made a fortune if you were short. There was a downtrend line I had. There was a bear market rally, and that downtrend line got extended. So it was a breakout and a back test, and then there it is. And it's been dead money since. It's been moving sideways, you can see, in a range. So I just wanted to bring that up. There's the weekly chart. And again, this stuff's not random. This is Yeti. Great. Look at that great growth stock. And then boom, it's just been dead since. And put in, again, the technicals forecasted that. And I just wanted to say that with Lululemon too, for those of you who say, the brand is unstoppable. It's a great brand. Doesn't matter. Certain things happen in the marketplace, and that's just that. So again, my opinion was kind of neutral to maybe short-term bounce first, and then either reshort or get out, or hey, if you like it, take it here. It's at support. I'm talking about Lululemon again. Take it at support with a stop somewhat below. I showed you where the next support is if that level goes. And then again, my tangential brain, I was talking about Home Goods, which is owned by TJ Maxx, which is symbol TJX. And here's my weekly chart right here. This is a super duper long-term primary. This is what we call a secular bull market uptrend line. A secular bull market is a primary longer-term trend. There are plenty of cyclical bear markets in there. These are all double-digit drops. It doesn't look like much because I'm zooming back into the mid-90s. That's a 65%. That little blip right there, 65% drop. The stock lost 2/3 of its value, dropped in half right there, and so forth and so on. So let's zoom in nice and tight. Where's the stock going? In my opinion, at least to that, even if it retains its great super secular bull market status, I'm calling it back down to that trend line is the most likely stop. What does that mean for the stock? Depending if and when and how it gets there. In other words, charts are dynamic. It's going to drop at least 14% to get there. You can see my support levels. I wouldn't even call this a target because we're so close, but I wanted to point out it's starting to crack on the weekly chart. Closed right on this. That's the primary secular bull market uptrend line. This is the cyclical or near-term bull market uptrend line from the 2022 lows right there. Big old wedge, negative divergence, everything you saw back here when the stock fell 30%. And so there it is. So there's your targets. That's just, you can call it the first start. It's too close for me to, so I call that S1, first support 93, maybe a little hiccup there. First target really comes in with the trend line if and when it gets there, about 86.50. There's the uptrend line. However, Nothing lasts forever. Again, this is a very long in the tooth secular bull market uptrend line from going back to the mid 90s. And when that breaks, it's going a lot lower. And by the look of it, I think it will break sooner than later. And like a lot of things this year is my guess. And that's going to take it down to probably right here. I'd say that's a decent target, about 55% drop. This is my daily chart here. Let me just, this is the line no, this is my line right here. That matches the one on the weekly. I had a yellow one there. So that's it. I just haven't updated it on the daily. A little that evening star doji right there. I believe that's what that is. Pretty much that was a divergent high. There's a reversal stick there, candle. There's your divergence. This is the same divergence I showed you on the weekly. It just carries forward. So this is an active trade right now. I'm making an active trade. It's an objective short entry. It broke the trend line the other day, last week, with a very impulsive red candle. It's been back testing from below. You can see I have a yellow alternative trend line, very much liking that one. And if you want to play it safe, and I get it, it's been a resilient bull market for the last year. I will give it that. Again, I'm going to go over a lot in this video that shows me we're getting really, really close to, I think, kind of one of those pretty big drops here that I've been talking about. Again, 433 hasn't gone yet on QQQ, but we're so close that I have to do these videos in advance if you are interested in this, so you can act if and when you get those sell signals. Because if I am correct, they're not going to let you in if you don't, if you're too late to the party. You wait a week or two, say, oh, you know what? Randy's right. We broke all those support levels. A lot of those stocks were going lower. The market may be already halfway or all the way down to my, that third or fourth target, T4, whatever I'm targeting on QQQ, a good 10+% drop. And at that point, it's too late, because then that's, we're going to bounce from there. We're going to hit the 200s on or around there, and buyers will probably step in. So, just wanted to point this one out. And there's that to play it safe number. I'll set an alert just so I remember to follow up on this one. Break below 95.60 should do the trick. Call it 95.50. And that would take you down. I gave you some targets a minute ago. I'm just making some adding. There it is. Perfect. Look at that. I love that. You've got nice, a lot of reactions there. A little false breakout. Another one. Real breakout. Back test. Love that target, 91.43, and the 200-day simple and exponentials coming in together perfectly. They're intersecting right now. Triple support, 5%. It's not much. It's just an initial target, and then I think these other targets will come into play later. So there's TJX, and again, my tangential brain going to the bigger picture. I covered this one recently, this week and last, I think, at least this week. TJX is a retailer, so XRT is the retail sector ETF. It's going to have it in there. And I talked about this along with the biotechs, how they had a beautiful, very well-defined sideways range. They had a breakout recently, a breakout which I predicted would fail if and when it occurred, even before it did occur. That we'd get a breakout. I think that was a biotech I was covering a couple of months ago. Just like the biotech, this one was a breakout that was destined to fail because you had negative divergence, overbought conditions, and a big old fat bearish rising wedge pattern, all of which broke. So you broke the wedge pattern, you fell back into the trading range. That means that's a failed breakout. And there you go. Retail stocks are on a sell signal. XRT. There's my first target. Well, I'll give you another one. I know. I'm speaking. I'm sorry to sound presumptive. I've been doing this long enough. I know how people think. We got the final kind of capitulation, a couple capitulation posts earlier this week. That kind of helps. When you get that and people are throwing in the towel, I can't extrapolate the entire universe of stock buyers in the U.S. stock market, traders, but when you kind of get it on the board here, and I've had these periods, same thing on the downside. When we're in a bear market, a bear trend, I start calling bottoms and nobody's interested anymore. That tells me that's usually when the bottom's in. Same thing on the top, when everyone's given up on shorting and has resigned themselves to the fact they're going to buy every dip because the market's going to go up because Kramer said, or then that's kind of a good sign. Anywho, it's technically I love it. It's just one sell signal after another. And then I think when I covered it the other day, I said a break below 74.19 which should do the trick, or I had a yellow line there. There it is. So there's your target, 70.82, roughly 67.72. And remember, when we break out of a range, a trading range, a failed breakout, usually the next stop, not, there'll be counter trend bounces along the way, but once you fall back in, you're usually going back down to the bottom and quite possibly down through the bottom of the range. So there's your kind of swing trend target. If you shorted this one here or the other day when it was mentioned, that's 24% or so just to get to the bottom of the range. And then where we go from there, we'll see. That's XRT. So I've just covered a sector, stock within a company within the sector, and then that sells products, and then one particular product within the retail sector. So that's why I went kind of backwards from, Lululemon and Yeti. Yeti's kind of over already, and then up to TJ Maxx, and then of course the XRT's retail sector. Okay, now let's just rifle in. Before I get to my things to watch, I'm going to just start out with gold and silver and do an update there. Okay, so if you remember yesterday, even going back to a week ago, when I first threw out the GDX short about a week ago, remember we had GDX long, and I said the one thing right after that post went out, I said I'd have more confidence in the trade if we didn't have this bullish falling wedge. This is EUR USD, the Euro US dollar, gold and silver tend to move. There's been a brief disconnect recently, but a very, very strong positive correlation. If you chart the Euro against the gold and silver going back years, you'll see a very strong positive correlation. They tend to move together. Again, there can be periods of brief disconnects where the Euro is going down, but yet gold and silver going up when there's tremendous demand, as there happened recently. I'm starting to see some signs that we could have even a more significant drop. I'm reading all the headlines coming out, how much money Costco's making selling gold bars and all that. Kind of the kiss of death. I saw the same exact thing back in 2011. I talked about it when gold had the end of that last bull market, and there were just commercials everywhere, all over TV. Sell your gold, all these outlets and stores and online places you could sell your gold, and that was certainly kind of the kiss of death. But all right, so bottom line, when I gave you that wedge, I gave you a couple price targets I saw were certainly possible. Instead, it would just be a counter trend rally, and including this downtrend line. Then I did an update the other day right when we were at there. Boom, that was it. Got rejected. We had that bearish rising wedge. This was today's hot CPI number. Remember, this is the Euro US dollar pair. So when the euro is going down, the dollar's going up. Why did the euro fall against the dollar so hard today? Because our inflation numbers came in hotter than expected, or at least hotter than those that have blinders on and aren't looking at what crude and everything else has been doing. Again, I think the numbers should have been even hotter than they were. But either way, that's why that happened. Now, you can see we hit that support level right there. That's 107,250. Beautiful support. And so, that was a lot drop in one day. But that was it. So this hasn't yet been fully priced into gold and silver. That's a big reversal. And remember, I told you I updated the GDX trade the other day. I initially given you a stop, but then I reiterated I still liked it, went up higher, and said you might if you shorted. We had a breakdown in gold the other day, right here, broke down and back tested the trend line. That's the minor uptrend line here. So I still think there's a good chance gold and silver. Remember, long term, the breakout's very bullish. The breakout to new highs in gold. Don't get me wrong there. Near term, too many people pound on that train. I wouldn't chase it here. Yes, shorting it is very counter trend and aggressive, but I do think too many people are on the bull bus right now in gold and silver. So I'm still targeting a pullback to that level. You can see other levels here, and quite possibly a retest. Oh, there's the breakout right here. Retest of this breakout. That could take gold down quite a bit. That would be 11% drop. The miners would probably drop at least twice that. And then I'll get to the miners in 1 second. There's silver, 60-minute chart, just starting to crack here. You got the divergence. Silver's playing a game of catch up to gold. because it had lagged so much. Gold broke out to new highs. Silver hasn't yet done that. So silver's been catching up, as I said, it often does when it lags gold. But GDX, that's the one right there. There it is. There was that breakdown I highlighted the other day. The back test, another back test, and then it's still a divergent high, and it's starting to come off that divergent high. Minimum, I think it's still coming back to this trend line. But I gave you these 3 targets the other day, last week, I think it was, and that's where I'd still maintain 31, 30, 22-ish, and then 29, 29.10 still a max target. If hit, going to be about a 13% drop. And now let's rifle through. I just got a price alert on IWM, so let me check that. Don't know if you heard that go off. Okay, we're back to that. Remember, I covered IWM earlier today. Zoom in. Sorry to make you dizzy here by zooming, scrolling so fast. Big level right there, guys. That's my yellow line. We're flirting with it now. And I'm doing this video because it looks baked in the cake to me. I thought a few weeks back, remember, when we were in QQQ in the trading range, I thought we were going to take out 433, get that sell signal. It didn't come yet. We continue to bounce in that trading range on QQQ. Guys, it's imminent in my opinion. Yeah, I'll just tell you, I'm all in already. I told you I was going to wait till QQQ, and I've just added on this bounce today. There's too much evidence right now in the charts for me, and I'd rather not. I'd rather just get in now. You guys can wait. Look, we're right there. I did say this morning, and it wasn't objective to buy. Remember, we bounced. It was objective when I did the last video. We bounced, but right back to resistance on, and that's where I loaded up on IWM and QQQ. Covered that earlier today. That was the 15-minute chart. It was the futures, actually, I was covering as well. Yeah, it was the futures on NQ. We were at big resistance there. Now I'm going to rifle through everything else and tell you why. It just looks baked in the cake to me. Again, so now we are on my index and sectors. Again, it's just one of many watch lists I have. It's a various compilation of different indexes and sectors. This is IAI, the broker-dealer ETF for the broker-dealers index, and that's your, of course, the broker-dealers. You've got CBOE, and, you'll have, I think they're all in there, IBKRs, Interactive Brokers, Schwab, Raymond James Financial. You got a lot of them in there. I don't have them all marked up, but I'm just going to go over AI again and just show you collectively. And I highlighted this recently, told you it was one of my favorites for a short trade. We had a beautiful bearish rising wedge right there, negative divergence, and it already broke down, and it backtested again. Now it's moving lower. And what I'm seeing today, and the reason I'm doing this video, a lot are taking out those lows. IWM just right on there right now. QQQ is very close. And then here, this is support too, 111.30. I think when I did the last time I covered this, I would have taken the measured target. That's what this was, of the wedge, added to breakdown point, and told you there's my swing target. If you want to keep it simple, if you want to keep it a little less simple, you can actively game the bounces. I told you, if QQQ takes out 433 and we get some of the FANGs or former Mag 7 stocks taking out my yellow support levels, me personally, I'm not going to try to get cute and game the initial, bounces off the initial support levels. I think they could just get sliced through. Again, if we get those sell signals. And so that holds true here. I wouldn't attempt to game 111.30. We may get a reaction. It's decent support, but this is, again, keeping your eye on the prize. A single target, you could target that 105, a little above the 105, 40-ish level. And, may get a reaction there. But again, that's kind of the measured target of the wedge. It's a nice level there. And I think, I even put up fibs for you, Fibonacci retracements. So that 103.75, a little bit below it, is also good support. And it's the 38.2% fib. So look, guys, even if you don't share my longer-term bearish outlook that says we're going to take out the 2022 lows in the stock market and you're bullish, then, I would think even some of those longer-term bullish folks are looking for at least a correction, a pullback to buy into. And that'd be a great level there. You have the 200-day moving averages right here, simple and exponential. You have a 38.2% Fibonacci retracement level there. That's a typical counter-trend correction in an ongoing wave. So where short sellers can use that as a price target. Bulls can use that as a level to get in if you want to get in. I look at the weekly charts and they're pretty ugly to me. But we'll see, guys. I take it one day at a time. We haven't even triggered the majority of my sell signals yet on the indexes. I just wanted to get this out in case we do. So you can then have, I'm doing this again twofold to kind of give you a big macro perspective of all the, various sectors, and then also trade ideas. A lot of these sectors I cover via these ETFs, so they're tradable. You can, some of them may or may not have inverse or leverage. I'm just going over. I like to chart the one-time non-leverage sectors. This one, to best of my knowledge, does not have an inverse, but it may. If it does, you find that out, just post it in the comment section. All right, I have to move a little faster or I'll never get through all these charts. MG 421 is the symbol for the national investment brokerage companies. Those are your big ones like Morgan Stanley, Goldman Sachs, Schwab, beautiful bearish rising wedge, still in a bear market. There's your highs, making lower lows, downtrend. Does need to take out these lows to really say that you're in a longer term bear market. But what I can tell you definitively is we're right below downturn line support. Big old negative divergence, no different than the negative divergence we had right here and right here. And that caused this drop here, which was from high to low off that divergent high. That was a 38% drop. Then we rallied off a divergent, aka bullish divergent low, and then dropped, had another leg down, 48%. I see really nothing less than the average between those two, 30, 40, 50% drop. Probably quite a bit more in a lot of these brokerage firms, believe it or not. These, I just move up these divergence lines until they're gone. And when I can't draw these divergences on the majority of stocks and sectors and indexes, then I'm just, it's wishful thinking to make a case, for again, a big drop in the market, not just a little 5-6%, 7, maybe 10% pullback that a lot of longer term bulls are looking for. I'm looking for major tops here. I'm getting off topic because I can't. If I go through all the components, that's what I did, my little squirrel moment. I'll get back on task here, back to my index and sector list. PEJ, I highlighted this one last week, I believe it was, or earlier this week, as one of my favorite sectors. Similar, some overlap related to the restaurant short EATZ that we have. And this one I mentioned too, PEJ. And there's your sell signal, came today. Yesterday we had an intraday break followed by a stick save, meaning the candlestick closed above or right on the trend line. Today, very unlikely. You'd have to rally from where we're at right now just to get on the trend line, about another 1%. Possible, but let's just give this a check mark since we only have a couple hours left in the trading day. That is the sell signal we're looking for. So if you were, wanting a little more evidence, there you go. Now you want even more evidence, you can wait for QQQ to take out 433. You can wait for a lot of the FANGs. But if you do that, some of these sectors you want to get in front of, they're the first to roll over. I've preached the benefits of, you can either keep it simple, trade the indexes. I like that. I do both, by the way. I do both. But, by and large, in my primary trading account, which is a taxable account, futures for the huge tax benefits, being taxed 60-40 long and short-term capital gain rate. And even if it's a short-term trade, that's the thing about them. And then, of course, if you short ETFs or go long ETFs and stocks in a taxable account and you don't hold it for a year or more or over a year, then it's a short-term gain. So then you're taxed at ordinary income, and that can really add up. Okay, PJ, there it is. I already covered that recently. UUP is $1. This is no mere coincidence. Here's the dollar going up, which is that euro falling. Dollar's in a clear uptrend. It's the euro's in a downtrend. If you're not aware, there is a very high correlation between the U.S. dollar and the stock market. Same with the euro-U.S. dollar pair. That's why I look at that. So have no mistake about it. Remember when the stock market peaked, here's QQQ back here, end of November, and then early 2022, that's when the S&P peaked. And you can see what happened. The dollar was going up along with the stock market. The stock market was ignoring it, but the stock market typically doesn't like a rising dollar. Then it took it on the chin, especially when the dollar went up very strong. When did the stock market bottom? Technically, it was October. It was really a double bottom for the Nasdaq there, but that's when the S&P bottomed, and then early 2023, the Nasdaq put in a near double bottom, and but that was the official bottom, even in the Nasdaq. October. Look when the dollar bottomed. Dollar went down. That kicked off the rally. Again, it was even stronger in the S&P 500, and another dollar started moving up this point. And you can see that we had the biggest correction that we had up until that point in the bear market rally off the October 2022 lows. The NASDAQ 100 dropped substantially, white line. And then what happened here? The dollar started falling again, took the stock market to new highs right there. And but lately, hasn't gotten the memo yet. Dollar's rallying. Euro's falling. What happens when it ignores that for too long? Usually plays a game of catch up. So there's UUP. Just went over that because that is in my list of, it's not an index or a sector, but it's I put it in there because I like to keep an eye on it. eDow is an ETF, the equal weighted Dow. Dow is only 30 stocks. Doesn't mean much, but they are. I'll say this: there's only 30 stocks in the Dow, but it's infinitely more representative of the U.S. economy and the U.S. stock market than the NASDAQ 100, which has 100 stocks. I like to trade NASDAQ 100 because it's a concentrated tech sector or index, and it's also very top-heavy in the market-leading stocks that will determine which way even the S&P 500 and even the Dow, which way they go. But make it no mistake, Dow put in that, I don't have all these marked. You can see the divergence, guys. Big negative divergence. Last time we had a big divergent high like that was right there, and that was in the beginning of 2022. Okay, equal weighted Dow, JJC, that's redeemed. This is just a little side note. I have a lot of these I still left the charts marked up. Tremendous amount of commodity ETFs, both in this case copper. I have some agricultural commodity. And last year, a lot of the issuers, iPath, it retired a lot of these, and it just went to show there'd been like a declining interest in commodities. It was almost a kiss of death. It's almost inverse to what you've seen. For example, Bitcoin. We just had a flood of Bitcoin ETFs come on the market with the approval. That's often a kiss of death. Just like when people have given up on commodities, that's when you want to start buying them. So anyways, my views on commodities. GDOW, Global Dow, beautiful bearish rising wedge breakdown. So this is a common theme, guys. I'm not trying to beat a dead horse. I'm just trying to show you on so many different sectors, indexes like this. This is a broad base, the global Dow. This is a around the world representative of U.S. and non-U.S. stock markets. Breakdown right there, big wedge. You look at a weekly chart, giant divergences there. They've been building for some time, and that tells me the next leg down based on this weekly chart, it's going to be something similar to what we saw back there in COVID and similar to what we saw when we had the divergent high, except this divergent high is even bigger than the one that we had back in the beginning of 2022, which saw the global Dow drop by 27%. So therefore, my expectation is we'll take out those lows. So this is probably what we're going to see, about a 42% drop over the next hard to time it, really. We need to get some of those sell signals I've been waiting on. Near term, you can look there. Well, I already gave you that. That's what I had drawn on the daily. But you can see, again, the takeaway is a lot of these sell signals are firing more and more. I have a tremendous amount more evidence right now to start, to get, increase and add to shorts than I did a few weeks back. XLE, remember that's one of the sectors in the S&P 500, and when I've been highlighting those, I said, look, watch top four. This doesn't carry the weighting that it used to. It's only back. This is in 2022. I haven't updated since the end of 2022, so it's been a little, over a year, almost a year and a half, but 5% weighting. But I said it was the thing. It was one of the smallest, but it was one of the most bullish, and that's what you don't want to see. Obviously, if you have all your money in an S&P 500 index fund, your 401k, of course I want all the sectors to go up. Nope, not this one, not in an inflationary environment. You want it for the last 20, 30, 40, 50 years. It didn't matter. It was contributing healthily to the S&P 500. Now this sector is going up because oil is going up, and that's everything right now. It's inflation. So Anywho, there's that. Couple of them I'm going to get to in a second. Subsectors of the energy sector. There's XRT. I already covered it. Failed breakout. Active short trade. XOP. This is the oil and gas exploration and production ETF. Trend line there. It's probably going to come back in and check that. I'm kind of neutral to bearish on it. I think it'll go down. It'll fall. If the market breaks down, we get the break of those additional sell signals I'm waiting for on the market, then we'll most likely come back in on especially these guys, and XES, which I'll get to in 1 second. There's SPY, the S&P 500, divergent high, kind of rolling over, but I have on a different board here. There it is. Still needs to take out, really, get the party started. 502.81. That's my yellow level there. VTI, Vanguard, total stock market ETF, that clearly broken down below the bearish rising wedge. Let's see, FTSE, Wilshire 5000. There's the same, it's almost an identical chart. It's the same thing. It tracks, I believe, the VTI tracks what was formerly the Wilshire, or still is, I don't know. There it is, the breakdown below the wedge. Secondary trendline break in play right now. If we close today, let me get rid of that. If we can take out, and look, and the thing is, we're starting to punch through the previous lows. So that's what I'm looking at there. So XLB, basic materials, just a sector. It's not going to move the needle. But again, when I covered this a few weeks back and I was covering the sectors, remember I told you I'd just focus on the top 4. This one doesn't move the needle. It's one of the smallest weighted sectors in the S&P at about 3%. However, it's one that it's been bullish. Now it's going to correct too. It looks like a failed breakout is about to occur. Negative divergence, breakout to new highs. But this rally, even though it's a sector of the S&P 500, has not been good for the market because this is basic materials. If they're going up, these companies are making money that's produce and distribute and manufacture, produce basic materials, then that is net inflationary. So. MUB, Muni Bonds, a municipal bond fund. This is a national muni bond fund ETF I follow, and you can see it's been just locked into a big old trading range. You had this purple trading range back here. Trading range there. That's COVID. Rates were here. Remember, falling rates. This showing you the price of municipal bonds, meaning it's inversely to the rates. So rates were at record lows right there. Then you broke the range. You had a waterfall sell down into this range here. And this has been the range. And recently we're coming off the top. We had negative divergence. And this means borrowing costs for municipalities are going up because rates are falling. We did just hit support today, or we're right at it, right there. I have a support level about 106. But overall, the MO is typically when you get to the top of the range, you're going down to the bottom. Here you topped again, then the bottom. Up there at the top. So we'll probably see higher rates coming. And that's no bueno for the economy because, again, these are your local and state municipalities. Rates go up, their borrowing costs go up. They're going to have to reach out, tax you, whether it's property taxes, sales tax, whatever, however they generate their revenue. Not good overall for the economy. And for the consumer, of course, who's already tapped out. DJUSRR, railroad stocks. Again, it's a common theme, and I'm going over sectors that some have nothing to do with others. This is wash, rinse, repeat. This is a divergent high, drop. Divergent high, drop, divergent low, rally, and still into this rally here, and then divergent low, rally, divergent high right here, bearish rising wedge, breakdown, and been pretty consistent stair-stepping down in the railroad sectors. Why does it matter? Transportation stocks. If the economy is booming, and this is a leading indicator. If the railroads are getting a lot of bookings, they're getting a lot of orders, they're moving a lot of freight, then obviously they're doing so because people are buying a lot of stuff and the economy is doing well. Some of this also attributed to that big IRA. Hurts me, pains me to even say it. The biggest gaslighting name of any bill passed in the history of the the country, calling it the Inflation Reduction Act. Everybody knows it's been done the opposite, inflation increasing. Anyways, but there's a lot of federal money that's going into there, and construction and building process and things like that. So that's helped them, and that was priced into it. Now it's saying, what's going on here? We're dropping. We just took out support, and probably not done going down from the looks of it. NASDAQ Composite still needs to break my yellow level, 15,926. I'll give it credit. It's holding up, and there's a lot of juice in this. I'm still calling it down, just like QQQ down to the 200s. And right there's your sold target if you would want to. There'll be a bump right here along the way, but you don't trade the composite. You trade the NQs. I don't even think there's an ETF that tracks the NASDAQ Composite, to the best of my knowledge. There's thousands of stocks in it. The NASDAQ 100, what we trade, is the 100 largest in there. And so but this is how it should play out. Breakdown there will be a sell signal. First stop there is going to be a drop from where we're at right now of about 6%. Buyers will step in there as they often do. Then once that breaks after the first reaction, take us down here. That's a 10% drop. And we'll have hit my 200-day moving averages, which is my preferred swing target right now in QQQ. IYT, the trannies. We're not talking about dealing with Bud Light. This is the transportation sector. So you have in here the railroads, the airlines, and trucking, all of them in there. And it's a great kind of indicator or tell on the economy. What I can tell you is, like so many things, this thing is peaking out, looking like a multi-year top. Now, bulls see glass half full, and they see a big resistance level to be taken out and send the trannies on to new all-time highs. What I see is a level here since early 2021 that we keep failing at. So with the stock market being at all-time highs and a lot of the big Mag 7, why aren't the transportation stocks at all-time highs, even with the massive federal stimulus from the IRA? Here they are, and they just broke down. So that I can tell you factually. We have massive 1, 2, 3, 4 reactions on this 71-ish level there, and we just broke down from a bearish rising wedge. So to me, this correction looks like it's just getting started. Yeah, that's the first target. Bullish if we can hold that and then go on to break out the new highs. Very bearish if that 66.71 level fails. And again, time to time, I just have to go to the weekly charts to show me the bigger picture. And I see massive divergence that's been building for years. So this is a sector that, in my opinion, hasn't even rolled off. Again, it's a slow playing out bear market. First leg down, equal highs. We haven't made a new high, and we'll come on down. And before all said and done, we'll at least check the previous lows. That would be the first stop right there. And then I think before all said and done, minimum come on down to here. And maybe if things get ugly, we visit our COVID lows from a few years ago. That'd be one heck of a drop. We'll see. We'll take it day by day. Here's QQQ. I've covered it ad nauseum lately, so I'm going to skip that. IWM I already covered. RSP, equal weighted S&P 500. Nice clean bearish rising wedge breakdown. And it's just took out today. It took out the previous lows. So like a lot of things, it's in a very near-term downtrend, making lower lows and lower highs. Again, very near-term. Next thing we need to see it take out is this reaction low right there. And that should open the door for a move down to 158.84, followed by this target down here about the 200-day moving averages and roughly 155 or so, somewhere in that area. This is just the actual index. RSP is the ETF that tracks the equal weighted S&P. There's the equal weighted S&P. PSP, private equity. Rising rates are not good for private equity. So you can see big divergent high. Once it breaks 62.83, it's going down to 54.50. 200 days will come in somewhere in here, but this one's probably coming back to at least that 56.68 in the coming months, especially if we get those additional sell signals I'm looking for. SMH, I've covered the semis. This is one of many semi ETFs. Still under that big bearish engulfing candle. The semis as a whole. This is just one of 3 semiconductor sector ETFs I follow. SOXX, you already have targets on. That one's still an active short. We've got T1 down here, 209, T2, T3. Let me get back to my watch list. That was SMH. We're on XLP, consumer staples, one of the big sectors in the S&P. It's already broken down. It's clearly broken down. There's a great example. Clean, no back testing, no nothing. Sometimes you back test quite often, especially in a resilient market. There's been a lot of dip buyers. And sometimes you break down, you never look back. That's why, it's hard to tell if, take it on faith. Short either a full or a half position on a breakdown when you're looking at something like a bearish rising wedge or an uptrend line break. And you can either go full position and then you just have to allow for a kickback, a back test, or you wait half position and you short another half. But the thing is, sometimes you never get that back test. And that's fine. You guys have to decide, how you want to do it. And again, the reason I do this video, and it's so long, I go over so many charts, I always use that analogy, that courtroom analogy, the criminal prosecution. The defendant is innocent until proven guilty beyond a shadow of a doubt. And the prosecution, the more evidence they have against the defendant, the more likely the prosecutor is to get that conviction. And so the same way, if you're going to be shorting one of the strongest bull runs in years, you've got to have a lot of evidence. And that's why I sit here and talk for almost an hour and showing you multiple charts, how they're starting one after another is breaking down. And again, we're very close. And look, guys, I've seen us come really close to the edge before. We saw it last year, and we didn't get the sell signals I was looking for. And in fact, at that point, I pivoted and went long. That was the purple levels in QQQ, the purple lines back here, and all the market-leading stocks, Alphabet and Apple and all the other ones. That was, again, I'm going off on a tangent right here, the purple lines. We had so many stocks at the 200-day moving averages. That back here, I'm sorry, including Apple right there. And so that's when we pivoted and went long. So we were close to it. And those were the levels last year I was wanting to see break to tell you with a high degree of confidence that my long-term next bear market targets, next big leg down in the bear market would start. And so not only did they all hold, but we reversed it, closed all shorts and went long off that level. But here we are again on at least on Apple. Apple's back to those key levels, and the rest of the lot, the big Mag 7, they're still comfortably above my purple levels right now. So at this point, I'm just looking for that, initial pullback. But we'll kind of see where we go if and when we get the breakdown on QQQ. Okay, back to my list. XLK, I've already covered that quite a bit recently as well. Right on my key 204-ish support. XAL Airlines starting to crack this minor uptrend line right here. XLU doesn't move the needle, so I'm going to go skip through it. Gold I already covered. KRE Regional Banks, I had a sell signal today. I have a minor trend line right here, just broke below. They don't like higher rates. As you know, that's what blew up the regionals before, caused two of the largest bank failures in history. We had 3 big bank failures last year. Fed had to step in and save them. And they're in the same position. They blew up because they had a crap load of long dated treasury bonds. Those treasury bonds are, they were 15, 20, 30-year bonds. We're only a year past that point, so they didn't go away. They don't have any less duration on those bonds. That's the duration is the price movement in a bond for every 1% in interest rate changes. That's your duration, how much a bond will go up and down. So longer the maturity on a bond, the higher the duration is. So they're in the same pickle. Fed will still have to backstop them. And bottom line is these higher rates are not good for the banking sector. And everybody believes, Fed's always going to bail them out. And we'll see. It's going to be a pretty interesting election year. How much taxpayer money will continue to be used to bail out these, the banks and when times are flush, they're making crap loads of money, paying out bonuses. But as soon as, they're mismanaged, they weren't managing their bond portfolio, their liabilities. I don't know. We'll see. I just want to point out that's what's going on. Regionals are down 5% today. That hotter inflation number is not helping. And remember, it's all about treasury bonds right now and yields. EM, emerging markets, all I can tell you, I've got it at pretty good resistance right there. It is in an uptrend, been in an uptrend, got a little bit of divergence going. This will go down. If the U.S. markets crack, emerging markets will go down with it most likely. So If you're bullish, you need to see it clear 42, and it would be better to see the U.S. markets hold the support levels I've been highlighting recently. QQQE equal weighted, same kind of story, rolling over, not going anywhere, moving sideways for months now, but big negative divergence, and that's what tells me that the next, double-digit move will be to the downside and not the upside most likely. Nothing's guaranteed, but that most likely will go to highly likely once QQQ gives me, and some of the top sectors and Mag 7 stocks give me those additional sell signals that I'm looking for. Moo Ag Business ETF, this is looking better than most, coming off a divergent low. This is the thing, guys. I just showed you a ton of charts, almost all telling the same story. Divergent highs in those that have recently broken out. Many of those breakouts have failed. Here's one at multi-year lows. This is these are companies that are these aren't agriculture. It's not an ag ETF. It doesn't hold wheat and corn. It holds John Deere, Caterpillar. Those things are used in agribusiness. And anyways, there's a trend line there. PPO crossover pending, bearish PPO crossover. Look, the thing is, guys, they're all stocked. If the stock market rolls over, even though I've been bullish on ag commodities, we're doing great on that ag commodity ETF, DBA. It's on fire. Ag commodities are moving up. This is inflation for you right here, but it doesn't always translate over into the companies in that industry. And remember, they are stocks at the end of the day. So if the stock market takes it on the chin, those companies will go down as well. FXI is China. I don't have much of a read on here. PBE is biotech. I mentioned that recently. At least it was IBB, had a failed breakout above resistance. This one never made it. This one just got rejected off resistance. XME. Oh, here's one. This is the metals and mining ETF, except instead of the gold mining stocks, that's our GDX trade. This one I like, and this is also an objective short trade, I think, right now. You have companies like, you can see, first of all, the divergent high. Just like you had a divergent high here. Oops, right there. And that happened. Just like you had a divergent high there, and that happened. So divergent low, at least on the PPO, and we rallied. So divergent high, come on down. Then there's a trend line. If that breaks, we're probably going down here. This has companies like Steel Dynamics, Reliance, which is a steel company as well. Look at that. And divergent high, trend line right there, pullback target below. CLF is Cleveland Cliffs, another steel company. Nice, beautiful little bearish rising wedge, waiting for a breakdown to give you a sell signal there. Royal Gold, remember we were bullish the gold stocks recently, caught the bulk of the leg up, and now I think they're ready for ripe for a correction. CMC, Commercial Metals, another one. ATI. See, this is why I go through. I don't just show you the sector. I like to look at the charts, and I'm seeing most of the same things here. This one looks better. Well, it's below a downtrend. It's in a downtrend. It keeps getting rejected to this downtrend line and the 200-day moving averages. So even though you've got the divergent low, be careful there. I could go on and on and on. There's Archcold, but I won't. I need to wrap the video up. IYR. This is a commercial or REIT ETF. That I have in my thing. Silver, I already covered silver for you. Biotech's I already covered biotechs, and GDX, I've already covered GDX. Okay, time. All right, I'm going to have to rifle through. That's just my sector list. I'm going to go through real quickly my, not all of them. I'll go through most of my TTW list, things to watch. MBI, this is a bond insurer. That's one of the things they do. They had this chart is a little deceptive because there was that big drop there. They paid out a special dividend, which accounted for that big drop there. However, since then, they've been moving lower, and I showed you what the municipal bond ETF is doing. So what's going to happen here, if I'm right on my call that we're going to have a hard landing at some point, probably this year, you're going to see a lot of talk, a lot of defaults and talks of defaults from municipalities and others. And so either way, this stock has clearly been in a downtrend. It peaked back here or at the beginning of 2022. It's in a bear trend, bear market, clearly. CRMT is CarMart at big support right now, 58-ish You've got, divergence. You had divergence. It was a trade idea back here. Popped it to that second target off that support level right there. But yeah, anyways, it's looking like it's about to crack. And even though I would be careful of this one. I already had one false breakout at support. It's in my list. It's just one of the top losers today. I just sorted the list by gainers and losers. Specialty finance. You have companies like Rocket Mortgage. Obviously, these higher rates are not good for Rocket Mortgage or any mortgage originator. There's Rocket, so probably going back down here. KRE, regional banks already covered. KMX, CarMax coming off that divergent high at nice big old, look at this resistance. Support, 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 support. Support once broken becomes resistance, resistance, resistance. Perfect, beautiful little short. Rally right into resistance with negative divergence, rolling over. Minimum target, this trend line. If that breaks, we're probably coming back down to the bottom of the range, maybe an uptrend line here. So there's a target area right there for KMX, CarMax. AMBC, another bond insurer. Duplicate that. Divergent high, wash, rinse, repeat, guys. This is not rocket science. Divergent high, drop, short it. Divergent low, rally. Divergent low, rally. Divergent high, correction. Look at that. We nailed that. I had 4 targets on that one. Those were put back March of 2023. And we hit 1, 2, 3, 4. Good example of a final target. Reversed. Come full circle. Now it's time to go back down. We just started moving lower. AMBC. ITB, I highlighted these as one of my favorites. Shorts, XHB, I showed you can use either one. Broke down, back tested, coming up. I think I covered that earlier today, didn't I? Yeah, I did. Okay, let me go on. AN, AutoNation, coming off a divergent high. TIPT, we shorted this one last year right here on the breakdown. We hit T1, T2, reverse there. Believe I talked about the odds for reversal, may even covered that one there. As I know I had this T3 initially, and now where we're at, we've come full circle. Just like we had a divergent high back there, gave us that drop. We went up, put in divergent high, we've been moving lower. There's a downtrend line right there. And if this uptrend line goes, and this 1534 support, these are your targets right here. And I think this time we'll get down to that $10 level on TIPT. IX 1160, auto and truck dealerships. That's a couple I just covered. CarMart, CarMax, and I'm about to get to Carvana. Same old story here, guys. Divergent high at major resistance. Look at this. Boom, boom, boom. This goes back to 2021. Boom, rejection. Boom. What happened the last couple times we were there? Well, let's see. Back in 2021, we've tried for months to get through that level and fell here. Rallied back up to it, got rejected, fell back down again. Rallied to it again. I expect nothing different. If anything, even more downside. And then there's Carvana. Carvana is still an active short. We shorted this one back, I think right here, somewhere in here. This is T1. We hit the first target. And as is often the case, we had a reaction, and we had multiple reactions. And so if I thought back here somewhere that this was a good first target because it was support, it's additionally been validated. So now it's excellent support, and it's our next sell signal add-on. I still maintain T23. All we did, we made a marginal, ever so slight divergent high. It stayed well within a reasonable stop if targeting T4. You've got this big old thin zone down below. And so all we need to do, and I'll set an alert to make sure I know it happens when it does, break about 74.40, and that should open the door for a pretty quick move down here to, and on this one, I would just personally, I'd favor it going down at least to T3. So that's going to be from where we're at now, about a 24% drop. FedEx, okay, FedEx, like everybody else out there, a lot of companies playing the stock buyback shenanigan game, a little shell game. Good luck to them and Apple and a lot of the others. I think when at some point in the future, I don't know if they're going to be able to face shareholder lawsuits. But I think when companies are buying back their stock at high prices, when I look at FedEx, and again, this is also a proxy for the economy, one of the best, FedEx and UPS. And these stocks, as I mentioned, I've covered this in recent videos, they peaked back in 2021. They have not made new highs. If the economy is strong or stronger, remember, the stock market is not the economy. The only reason the stock market made new highs is because of the Magnificent Seven. The majority of stocks did not make new highs. And this one is a tell on the economy. I've done this in the past. I don't have time now. You can do it yourself. Go back as far as the chart will go and overlay the S&P 500. You will see a nearly perfect correlation. When FedEx tops and the stock market makes new highs, the stock market has always rolled over. This was the top in FedEx. And now we've had a bear market rally. And by everything I see in the charts, that bear market rally is likely over, culminated in that little pop when they announced they reported earnings. Earnings, I think, were meh, but they announced that big stock buyback program, and they've been fading it. They've almost faded all of that pop so far. You can see the gap's about to be faded. And again, it's this big divergent high here. You have the same thing with UPS. Peaked way back here. Why, if the stock market's at all-time highs, why are UPS and FedEx two of the most accurate bellwethers, of the U.S. economy? Remember, if they're moving a lot of product and packages, people are buying a lot of stuff, they're going up. That's why they're in my things to watch list. So there it is. PZC is one of the California bond muni ETFs I watch. No bueno, guys. This thing is just going down. California, they're spend mode. They always have been, and it's going to come starting to pay the piper there. It's back testing this trend line right now, but again, look at this. These are yields going up, bond prices falling. And then I already covered UPS. MCO, another, this one, Moody's. Divergent high there, same story. And then the other two, and I'll wrap up here, guys, with Paychex and ADP. Again, I've done this in the past, even in recent videos over the past couple months, overlaid, and I encourage you to do the same. Long-term charts, go back as far as these stocks will give you history, overlay the S&P 500, and you will never see a point where the stock market, they are perfectly correlated with the stock market, nearly perfectly correlated. This is a massive red flag, one I've been talking about. So you're hearing the bulls, one big pillar they have, they've shrugged off interest rates as the lag effect. There is no lag effect. The economy's fine, so strong, rising rates don't matter. Time will tell. I still maintain there's a lag effect. We'll see. But what you cannot argue is why, if employment is at record low, unemployment's at record lows, why have Paychex and ADP, the two biggest payroll processors, why did they peak back in early 2022? And they've been moving steadily lower, clearly lower. There's your downtrend lines. Again, go back. You will not. The only time you'll see that in history where they peaked and the S&P went on to make new highs, it was before the major bear markets, and then the S&P dropped, 50% plus each time. So there's Paychex, there's ADP, and again, if anyone has an explanation as to why they peaked back here with so many other stocks, and they've been moving lower and they remain below their downtrend lines. It's just another one of many, again, red flags that say, hey, there's something amiss here. Anyways, all right, I will stop there. It's been a 1-hour video, but I threw a lot out at you. And again, I covered sectors that are all over the place, and I'm not trying to just highlight what looks bearish. I went over my index and sector list. I didn't skip out anything that was bullish. In fact, I highlighted those things that were the most bullish, and those were energy and materials, right? Of the S&P 500 sectors. So I just wanted to let you know that, to me, the technical evidence as well as the fundamental evidence, and this is a way to use technical analysis and kind of marrying it with fundamental analysis. Technical analysis is charts, but fundamental is the job market. If the job market's so strong, why have ADP and Paychex, why did they peak 2 years ago, and why have they been making lower lows, or lower highs, I should say, since then? All right, guys, I will end it there. Do what you want with your, your own positioning. But like I said, to me, there's just enough. I went over these charts today, and I took advantage of that bounce back this morning. And but I'm also an aggressive trader. I like to get in front of things. So if things change tomorrow, we get the PPI and the market likes what they're selling, then I already gave you levels in today's earlier video on the NASDAQ 100 where me personally I would stop shorting and also where I will start stopping out if things go the other way. Otherwise, as things go down, I still have a little dry powder to add, and that's what I plan to do. Oh, and let's not forget, I didn't cover it in earlier video earlier today. Mr. VIX looks ready to pop. I've been highlighting this recently. Big divergent low at support, major long-term support here. And we've been moving higher. Like I said, there was that post-FOMC whipsaw. I've talked about it all the time. Don't read too much into the initial reaction. We not only didn't get shaken out of our shorts, we used that to our advantage. Well, that's when we shorted. The last official short trade on QQQ or short entry was on the post FOMC pop, which would be comparable to buying the VIX there. And this is it. So these are levels I've given you for a while. Remember, the VIX has this ascending triangle pattern here. Other than this one brief whipsaw, we had a nice clean up trend line. It snapped back above it after the Fed, and it popped that 1573, and it's been at my 1673, which is my next and really last support before I think the VIX starts to let loose. If this happens, it will almost certainly coincide with that takeout of 433 on QQQ. And just don't underestimate how quick the VIX can go up. And so I already shared this with you the other day. You can use, if you don't trade futures, like I trade rolling. I started the Aprils are still trading, and I've got a pretty good amount of those. And I started layering into some of the Mays as well. They're starting to pick up volume right now. They're rolling into the Mays. So just keep that. If you're a futures trader, I don't have to tell you that. If you use the ETNs, they're short term or midterm VIX tracking ETNs. All right, that's it. Stop it here. This has been Randy Finney with Right Side of the Chart. Have a great day.